In this question, we're going to be disposing of a plant asset. So we're going to stop using an asset for one reason or another. Either it was no longer useful to us, it broke down, we've decided to sell it and upgrade to a newer, fancier model of the asset. It doesn't matter what happened. For some reason, we're disposing of an asset that we owned from our books. On January 1st, 2017, Boston Bats purchased two new pieces of equipment. So this company already has the equipment on their books. They paid $15,000 in cash for it when they purchased it, and they made their two estimates. You always have to make what is its useful life. They said it was 5 years. And what is it going to be worth at the end of its useful life? They assumed it was going to have a residual value of zero. And Boston Bats really intended to use these pieces of equipment for 5 years. But on September 30th, 2018, they ended up selling the equipment for $8,000 cash, way before the end of its useful life. Well, they have to record this sale, and the first thing they need to do before they record the sale is to bring depreciation on the asset they're disposing of, these two pieces of equipment, up to date, to make sure that the accumulated depreciation that these pieces of equipment are carrying is accurate at the time of their disposal. So we're going to prepare a depreciation table, just like we have been, starting at the date of purchase, January 1st, 2017. They bought it for $15,000, so that was its book value on that date. And then at the end of 2017, they recorded their yearly depreciation. Beginning book value was $15,000. They're going to use the double declining balance method, which means it's going to be 2 times the straight line depreciation rate. Well, had a 5-year useful life, so under straight line they take 1/5 away each year, but they're going to double it for double declining, which means 2/5. So the GDP rate is 2/5. If we multiply that by our beginning book value of $15,000, we come up with a depreciation expense of $6,000. Our accumulated depreciation is $6,000, knocking our ending book value down to $9,000. That was at the end of 2017. They're selling this on September 30th, 2018. So we need to bring depreciation up to date. Let's bring down our ending book value from the end of the prior period and make it our beginning book value for this period. So it's $9,000 as of September 30th, 2018. Multiply that by the double declining balance rate. And here's the catch. That double declining balance rate of 2/5 is for each year. But we didn't make it through the whole second year. We only made it through September 30th, which is 9 months. So when we bring depreciation up to date, we're not going to use 2/5, we're going to use 9/12 of 2/5. And little multiplication of fractions tells you that should reduce down to 3/10. So for the purpose of this problem, take your normal double declining balance rate and multiply it by what portion of the year had passed at the time you're disposing of the asset to get a modified double declining balance rate. And then multiply that by your beginning book value, and it should come out to be $2,700. Add that to your accumulated depreciation, $8,700, gives you an ending book value of $6,300. So to record the journal entry to bring your depreciation up to date, your current year depreciation, on September 30th, you're going to debit depreciation expense for the depreciation expense occurred during that year, which was $2,700. And you're going to credit your accumulated depreciation account, in this case for equipment, also for $2,700. We recorded our current year depreciation on equipment. And now that our depreciation is up to date, we can figure out what our current book value is for the purpose of determining any gain or loss on the disposition of this equipment. So to figure this out, you have to figure out what you're getting. The fair value of your assets received. Well, the information tells us that on September 30th, the company sold the equipment for $8,000 cash. So what are we receiving? We're receiving $8,000. From that, we need to subtract out the book value of this asset we're disposing of. So these pieces of equipment that we are selling originally cost us $15,000. That's their historical cost. Well, the depreciation table on the last slide told us that we had accumulated $8,700 worth of depreciation, and our books are saying that this couple pieces of equipment are worth $6,300 at the time we're disposing them. Well, we're getting $8,000 for something our books say is worth $6,300, which means we're making off better than our books say we should, and that is by definition a gain. And the gain is the difference between those two numbers, in this case 1700. So to record the journal entry, here's the things you have to have in there: the receipt of any assets, in this case cash, that you are getting; the recognition of any gains or losses. We had a $1,700 gain. We're getting rid of these pieces of equipment, which means we need to take them off our books because we no longer own them. And since we're getting rid of the equipment, we need to get rid of the accumulated depreciation account for the equipment from our books as well. So starting on September 30th, when the sale, let's recognize the cash that we're receiving. So cash as an asset goes up with a debit. Let's debit cash for the $8,000 that we're receiving. Recognition of a gain. Well, gains work like revenues, and since that's going to be going up, that's going to go up on the credit side, so we're not going to use that yet. Removal of equipment from books. Equipment's assets. Since we're removing it, it's going to decrease it, and assets decrease on the credit side. We know that's going to be a credit. And then we have our buddy accumulated depreciation, which is a contra asset account. Contra assets go up on the credit side, but we don't want it to go up because we're taking it off the books, so we need to debit it. So we're going to debit accumulated depreciation of equipment for the amount of depreciation that these pieces of equipment have accumulated at the time we're disposing of them, which, since we just brought our depreciation account up to date, we've determined was $8,700. Now we can throw in those credits. We have a gain on asset disposition, which I've seen called gain on sale, gain on asset sale, gain on disposal, anything along those lines. There's a million different names for this account. Gains, I put revenue in here because they're like revenues. The big difference is revenues come from your normal course of business. So if you are a carpet cleaner, you're going to have service revenue. If you are a merchandiser, you're going to have sales revenue. Gains are profits that your business takes that are outside of your normal scope of business. So Boston Bats, I'm assuming they make baseball bats. They're not in the business of selling pieces of equipment, which means they won't recognize it as a revenue account. It would go under gain. But gains work just like revenues for the purpose of your books. They go up with a credit and down with a debit. In this case, we're going to credit gain on asset disposition for $1,700. The last thing we need to do is take the pieces of equipment that we are selling off our books. Historical cost principle. They go on the books for their purchase price, and since they have to stay there at that value for the whole time when we sell them, we take them off at their historical cost. So we're going to debit or credit, equipment for $15,000. Our debits equal our credits. We sold a used piece of equipment at a gain. Best of luck on your quiz, everyone.